Welcome back. Today, we're looking at an investment analysis titled Bitmine Immersion Down 12%. Here's why the bulls are wrong to panic.
A very confident title.
It is. The core thesis is that BMNR's recent 12.62% drop is really just a deep value buying opportunity.
And the report points to 4 imminent catalysts that are supposed to reverse the trend.
Exactly. But even with that strong foundation, we need to make sure the structure itself, really sells that conviction.
I agree. So let's start where the report does, with the initial drop.
Right. The trigger for the panic. It's attributed to macro fears, Bank of Japan rate hike rumors, and something the author calls the Ethereum tether effect.
Okay, that's all laid out pretty clearly. But I wonder if the material could more robustly connect the temporary nature of that initial panic trigger.
The sector sell-off, right.
Exactly. Connect that to the immediate structural strength of those reversal catalysts.
I can see what they were going for. They identify the drop and then boom, here are 4 reasons why the market is totally wrong.
And the logic is sound, but the wiring feels a little weak.
How so?
The weakness is that the 4 reasons for buying, while incredibly strong, we're talking scheduled events here, they feel slightly isolated from that initial macro panic.
Ah.
There's a structural gap in explaining why that big negative macro force is completely, neutralized by these internal catalysts in the super short term.
It sort of relies on the reader to make that connection themselves.
That's a great point, especially for a technical audience.
Right, because if the drop was caused by these big, diffuse macro fears, those fears won't just vanish because of an ex-dividend date. You need a direct rebuttal.
Exactly. The suggestion here is to directly address the perceived longevity of those macro fears. Frame the upcoming events like Fusaka and the ex-dividend date as these time-bound pressures that they override the external risk within the next 48 to 72 hours.
You're saying show that the internal clock is ticking louder than the macro rumblings.
Precisely.
Okay, so let's get concrete. When the analysis brings up the dividend trap for the December 5th ex-dividend date, it says the psychological effect creates a floor.
Which feels a little generic. It needs quantification.
So instead of just saying that, you'd want to see
data that undercuts that fear. Quantify the historical behavior of institutional funds around this specific payout. Or, cite some historical precedents for crypto-correlated stocks selling off right before an ex-dividend date. Show why shorting BMNR right now is a low-probability trade.
Okay, that turns a psychological point into a quantitative, actionable signal. I like that. But what about the Ethereum tether effect? The idea that algos sell BMNR just because ETH dips?
That's the purest technical trigger in the whole piece, so the rebuttal has to be just as technical.
You mean linking the Fusaka upgrade, which is on December 3rd, to that specific algorithmic selling?
Yes. Don't just link it to a potential ETH price bump. That's too generic. You need to frame Fusaka as specifically neutralizing that Ethereum tether effect.
So frame Fusaka as the anti-tether, the idea being if the drop was swift and machine-driven,
the reversal will be just as swift and just as machine-driven once Fusaka successfully executes. It proves the algorithm's whole premise was wrong.
That really tightens the narrative. It gives the reader a ton of conviction that the source of the panic is about to just dissolve on a fixed schedule.
Exactly. It tightens it immensely.
That's strong. But even with the mechanics connected, we have to look past the trade setup and ask, is this analysis bulletproof?
And that takes us directly to the question of downside risk.
Which leads to our next point. I think introducing a brief, focused section on potential downside risk and failure modes would significantly strengthen the overall conviction of this strong buy analysis.
I agree 100%. The material presents this incredibly bullish case, but any sophisticated analysis has to address the counter-arguments.
A purely one-sided argument, even if it's right, always raises a red flag for a serious investor.
And the weakness here is that the entire premise is contingent on success. The Fusaka upgrade has to work perfectly. The Maven launch has to materialize in Q1 2026.
If you omit those contingencies, it starts to feel a little incomplete, maybe even a bit promotional.
Especially for a technical audience that's looking for real due diligence.
Right, I can see that. It leaves the door open for a reader to question the objectivity. They're sitting there thinking, okay, I see your bull case, but tell me the conditions under which I lose my money.
That's the litmus test. So the suggestion is pretty straightforward. Include a dedicated risks to consider or conditions for invalidation section.
Show that you've thought about the pitfalls.
It demonstrates comprehensive due diligence, and it counteracts any claims of bias. It shows you're not just cheerleading, you've actually done the work to understand the failure modes.
Okay, so let's focus on the two main risks tied to the catalysts. First, the technical risk.
Fusaka?
Right. What if the Fusaka network upgrade has significant delays, or worse, a deployment failure? That would crush the bullish catalyst and probably trigger another wave of selling.
The analysis needs to address that head-on. A concrete example would be to explicitly state that the primary execution risk is Fusaka's deployment and that any significant delays could trigger a quick return to, say, the previous $25 trading range.
And second, the stock's valuation is so tied to its ETH holdings. So we have to quantify the sensitivity of the deep value argument.
That's vital. The report claims it's trading below liquidation value.
Okay, but what specific, sustained price floor for Ethereum would completely invalidate that claim?
You need to calculate it, the precise critical ETH price point below which the net asset value would drop below the current trading price.
It forces the author to stress test their own argument. You could say something like, the deep value thesis holds as long as ETH stays above X dollars. A sustained drop below Y invalidates the NAV discount.
It gives the reader a clear safety threshold. And finally, you should briefly mention market execution risk for the long-term play, MAVEN.
The staking network.
Right. Things like competition in the validator space or, regulatory changes that could impact the yield in 2026. Just acknowledging these elevates the report from being purely directional to being truly comprehensive.
Because a comprehensive strong buy is one that has already survived scrutiny. Okay, that brings us to the third core argument, the valuation itself.
Yes. Let's sharpen the focus on this powerful claim that the operating business is essentially being bought for free.
I think that argument, that the stock is trading below its net asset value, it needs a clearer, more mathematically rigorous presentation to really maximize its impact.
Right now, it relies on a pretty blunt comparison. Market cap of about $11.1 billion is roughly equal to total assets of $11 billion in ETH and cash.
It's a strong statement, but roughly equal leaves a lot of room for approximation, especially for this audience.
And given how volatile crypto assets are, saying the operating business is free based on such a tight margin, well, the math needs to be exceptionally precise.
In volatile markets, roughly equal just isn't good enough. We need to know the exact discount. Without that, the argument is persuasive, but it's not bulletproof.
It's a fantastic insight. The market is assigning zero or even negative value to the entire mining and staking operation.
But if you're going to claim an anomaly of that magnitude, the math has to back it up.
Absolutely. So the suggestion for improvement here is critical. Calculate and present the exact net asset value per share, the NAV per share, using the current $29 price point.
And frame it using established concepts.
Yes, like a sum of the parts analysis or a net-net proxy. Give the deep value claim that necessary academic weight.
That's the key to conviction. So for a concrete example, the report needs to find the approximate share count and then explicitly calculate the NAV per share.
Based on the 3.7 million ETH plus cash.
Then compare that calculated NAV per share directly to the current trading price of $29.
This is where the power is. This metric shows the precise dollar discount per share. So, for example, if the calculated NAV is $32,
then the reader knows they're getting an instant $3 discount just by buying the underlying assets, before you even assign any value to the business itself.
Exactly. And instead of that powerful but imprecise statement, you are essentially buying the operating business for free.
You need to refine it. Quantify the degree of the market's error.
That's where you drive the point home. Provide a specific, quantified residual value. If the assets are worth $11.1 billion and the market cap is $11.05 billion,
then the market is pricing the operating business at a $50 million negative valuation.
Right. You could phrase it as, the market is currently pricing the MAVEN staking business at negative $50 million, implying a significant, quantifiable undervaluation of future cash flows.
That specific negative number is much harder to argue with. It really drives home the deep value anomaly.
Because it proves the market is actively applying a penalty to a cash flow generating operation.
It transforms the analysis from just a persuasive piece into a quantitative imperative.
Absolutely.
This has been a really focused look at how to maximize the impact of this analysis report. To quickly summarize the actionable suggestions.
The core focus has to be on maximizing conviction and rigor. First, you need to more explicitly link that initial macro panic to the immediate time-bound power of the catalyst, like Fusaka and the ex-dividend date.
Second, integrate a real discussion of downside risk to establish balance and maximize the report's credibility.
And third, sharpen the quantitative argument for the deep value thesis by using a precise NAV per share calculation.